So last day we were having a discussion on groups, and we have the two areas from group. What was that? It was basic group structure and change in group structure, right? So apart from that, there are two other topics we have to cover in groups related areas. So then it will be on the base of foreign subsidiary. Okay, one part will be focusing on foreign subsidiary, another one with respect to group cash flow. Okay. So if you are considering the importance, this comes only after the change in group structure scenarios. Okay. So there are number of times they have tested the goodwill calculation and the scenarios that we have discussed yesterday. So today we'll be covering these two areas, that is how to account for the consolidation of foreign subsidiary and the group cash flow. Okay. So when it comes to foreign subsidiary, we have to learn another standard, is IAS 21. So IAS 21, it's dealing with change in the effects of change in foreign exchange rates. Okay. So deals with change in the forex rates. Okay. So we know that whenever we have a foreign investment or any sort of foreign subsidiary, when we are preparing the efforts, we have to translate these amounts or the efforts of the subsidiary company into our home currency or the presentation currency, right? So as part of that conversion, we need to learn certain rules. So now I'm focusing mainly on those rules that we are mainly applicable in the group related scenarios. The first one, it is identification of functional currency. The identification of functional currency of our subsidiary. Okay, that's your number one task whenever you get a foreign subsidiary kind of questions. So tell me, what is functional currency, guys? What is functional currency? Have you heard about this term, functional currency?
Where the entity operates.
Sorry.
Where the entity operates.
Is it like where their home location is located?
Yeah, home country.
Is it a major income and expense? Okay, okay. So functional currency means the currency of the primary economic. So if you are using the actual accounting terms, it will be recognized as the currency of primary economic environment. So what does it mean by primary economic environment? Where the business, the large volume of business happens for that particular company. So the primary location or the functional currency can be identified through certain factors. Okay. So these factors are divided into two types. What are they? Primary factors, secondary factors. So we have got two sets of factors here in IAS 21 that will help us to identify the functional currency. So the first one, it is primary factor. So what does it mean by primary factor? The currency that mainly influence the sale price of our product or service. Okay, the currency that mainly influence the sale price of our product or service. So just note it down. The first one was the currency that mainly influence the sales price of our goods or service. Okay, so we know that, let's say if there is any major changes happening in the UK governing body or in the European Union, we can see those changes directly in our ACCA fees as well, right? Because we know the functional currency of ACCA as a company will be pound. Okay, so this is how we'll identify the functional currencies. So first one, the currency that mainly influences the sale price of the goods or service, or we need to consider the economic factors, such as, otherwise you can learn it like the pestle factors. So what is pestle factors? The political, economical, social, technical, or legal. Okay, so these are the economic factors, external factors. So this pestle environment of is the pestle environment of which country's currency that will mainly influence our business. Okay, which countries or which particular territories pestle factors is going to affect our business, we'll consider that as your functional currency. That country's currency will be considered as your functional currency. Or another easy way is to identify the current cost. In which currency you're mainly incurring your current cost, such as labor cost, okay, or material cost. So these are the primary factors that will help us to identify our functional currency. Is that clear, everyone? I think most of you have heard about it in your classes. So we are just quickly going through it. So this is how you can mainly remember those things. So is that clear, everyone? The primary factors? Any doubts? Okay. So once the primary factors are found out, now we are moving to the secondary factors. So what are secondary factors? The receipts. Okay. The receipts of the operating activity. In which currency you are getting the receipts of your operating activity, as well as the currency from which mainly you are using the finance, or the currency from which we are mainly raising the finance. In which currency you are taking the funds. Okay. We need to check whatever the company's requirements are, from which currency you are getting the fund flow. Fine. So this is how we'll identify the functional currency of a subsidiary company or any company. This is applicable for both groups and individual efforts as well. Is that clear, everyone? Can you reply in the chat? Okay. So once you identify the functional currency, now we have to translate these amounts, which is in the functional currency, to the parent company's home currency. So that's how we have to do through the workings. Okay. This is the working that you have to perform. So whenever you are asked to calculate the goodwill of a subsidiary company, foreign subsidiary company, how will you calculate it? So functional currency will be identified, and initially you will be calculating the goodwill of our company according to the functional currency. So one thing you have to understand is when you're asked to calculate the goodwill of a subsidiary company, especially a foreign subsidiary company, that goodwill should be calculated in the functional currency itself. That is a cash or consideration that you are giving should be translated to the functional currency itself to calculate the goodwill, and the value of NCA, okay, and the value of net assets. So the basic formats remains the same. The goodwill calculation remains the same. The only difference is we have to calculate this goodwill according to the functional currency of our subsidiary. So once the goodwill is calculated, so once you get the goodwill at acquisition, later on we will translate this figure to our home currency. Home currency means the currency of our parent company. Are you getting it? So now the question is, what are the exchange rates that we have to use for this conversion? So it's very easy. When it comes to the goodwill at acquisition, we have to convert it using the goodwill at the acquisition, convert it according to the exchange rate at the acquisition date. So the exchange rate that should be used to convert the goodwill in foreign currency, it is according to the exchange rate at the acquisition date itself. Fine. Now, let's say in between the goodwill is getting impaired. If there is an impairment for goodwill, that impairment will be converted at the average rate. Okay, that is something that you have to note it down. So there will be a change in the exchange rate when we are converting the impairment, because we assume that impairment is something that happens over the year. So if the average rate is given, okay, then we have to use that. If the average rate is not given, then we can use the closing date itself. Exchange rate of our closing date or the reporting date itself. Is that clear? So we'll get that amount. So you'll get that amount in your home currency. So after adjusting this, after making these adjustments, that is the impairment, you will get the expected goodwill. You will get that expected goodwill. According to your assumption, you will get an expected goodwill. So average rate will be given in the question. Okay, average rate means, let's say there are different exchange rate over the years, over the period of a company, right? So impairment is something that happens over the period. It is not happening in a single day. Okay, so for expenses or any items related to P&L will be converted at the average rate. This average rate will be given in the question. You are not supposed to calculate it. And even in IAS 21, they haven't given any guidelines for calculating average rate. That's another criticism of IAS 21 itself. Is that clear? Fine. So now you will get the closing goodwill. You will get the closing goodwill in the foreign currency itself. Now the closing goodwill will get converted at the reporting date. Okay, the closing goodwill will be converted according to the exchange rate of reporting date. And finally, you will get the closing goodwill in parent currency itself. So there will be some difference between the expected goodwill and closing goodwill. Can you say what's the reason for that difference? There will be some changes in the expected goodwill and the closing goodwill. Can you see that reason for that difference? What will be the reason for the difference, guys? The reason is mainly because of the changes in the exchange rate. So whatever is the difference, that is from the expected goodwill and the closing goodwill, whatever is the difference, that difference will be considered as your translation gain or loss. Okay. So if there is any change in the expected goodwill and closing goodwill, obviously there will be some changes. We'll get to know once you are doing a question. So once you make that translation, there will be some gain or loss. That gain or loss will be accounted under other comprehensive income. Is that clear, everyone? So the first step whenever you are getting a foreign subsidiary question is to identify the functional currency. Once that part is done, the next step will be calculating goodwill. So once we calculate goodwill, we will convert that into home currency. At the time of conversion, since there is a change in the exchange rates, that will create a remeasurement gain or loss or a translation gain or loss. That gain or loss will be accounted under other comprehensive income. Is that part is clear, everyone? Are you clear with that format? Okay. In the same way, we need to convert our net assets as well. Okay. So we know that there will be changes in the net assets. So net assets at acquisition, that will be initially calculated in functional currency. Okay. Is it visible right now? Please just tell me. Okay. Like I think I have already explained a lot. I forgot to share the screen. Okay. Can you see the format right now? So we'll initially calculate the goodwill, and the goodwill will be translated at the acquisition date exchange rate, and you will get the amount in the parent company's currency. Then when the goodwill is getting impaired, we will convert it to the average rate. You will get that closing value, and closing goodwill will be converted at the reporting date exchange rate. Then you will get the closing goodwill. So there will be some difference between the expected goodwill and the closing goodwill that will be accounted under translation gain or loss under other comprehensive income. Is that clear, everyone? That part is clear now? Okay. So next one, we need to translate the net assets as well. So initially we'll calculate the net assets at acquisition in the functional currency. Then later on, in the same way as we have translated goodwill, now I'm going to translate the net assets as well. So we'll use the at acquisition date exchange rate itself. So you will get that amount in the parent currency. Okay. Okay. So now there will be some changes in the net assets from acquisition date to reporting date. What will be the reason for the changes? It will be mainly because of the post acquisition retained earnings. So it can be post acquisition retained earnings or the profit for the period, okay, or the loss, or there will be some fair value adjustment. So we have to provide the depreciation of that fair value adjustment. So these are some of the reasons for the changes in our net asset balance. Okay. So which rate will be used? Which exchange rate will be used to convert that post acquisition retainings or profit or loss? Such figures will be converted at the average rate. Okay. So when we are translating the net assets, again, profit is something that comes as a part of your P&L. Again, it's a P&L item. So that will be used at the average rate. So you'll get the closing figure there. Is that clear, everyone? Okay. So after making that adjustment, you will get the expected amount again of net assets. And in our functional currency, the net assets at reporting date will be converted at the closing rate or as per the reporting date. Fine. So you finally get the closing net assets in your parent company's currency. So as you have seen with respect to goodwill, there will be a change in the expected net asset figure and the closing net asset figure. And that change will be again considered as a translation gain or loss. And where will you record it? Where will you record this translation gain or loss? Where will you record this translation gain or loss, guys? Yes, it will be recorded in the other comprehensive income. We'll record it under other comprehensive income. So this is your main working note that you have to remember with respect to foreign subsidiary. So one working note will be there with respect to goodwill translation. Another working note will be there with respect to the translation of net assets. Is that clear, everyone? Can you reply in the chat? Okay, so we'll do one question. So just take out your question from March 2020. So that's where ACCA have tested the foreign subsidiary itself. So we'll discuss that question. So take out your kit and take out your kit. Can you see the question here? So question number 6 from your kit. So it's a question from March 2020. And this question clearly tested the knowledge of both functional currency as well as the translation gain or loss. That part got tested here. And it's not a sample paper, it's your exact question itself. And this is how your original question paper will look like. Okay. So if you look at the requirement, you can see that it's an overall 30-mark question. So first question is how the functional currency of closed company should be determined. So the knowledge is already there with us. We just need to apply it to the scenario, right? Now the next one it is, we need to identify one of the fair value adjustment of our subsidiaries company's net assets. And we need to calculate the goodwill as well. That is second requirement of question number B. And we need to allocate the impairment and how these things are getting accounted. So shall we do that question? All of you just quickly go through it. Just start reading through it. So we need to read it from first of all, read the background and read it till this exhibit 2. Okay. We don't need the acquisition of core and impairment of bonds. We'll discuss it later. Just cover these areas. Just read the introduction, the first exhibit, the second exhibit, and this exchange rates. Just quickly go through it. All of you just quickly go through it. Okay, so shall we prepare the cash flow here? Fine. So the profit before tax is given. How much it is a profit before tax? How much it is a profit before tax here, guys? The profit before tax is 209, right? Yes. So to that, we need to add the finance cost. Check whether the finance cost is given in the question. Check the finance cost is given there or not. No, they have not directly given it. So I can remove that line because it's not given it directly here. Now, what else needs to be adjusted? Let's look at the items. Share of profit of associate is included in the profit. So can we include share of profit of associate under the operating activity? No, we need to remove it, right? So less share of profit of associate. Less share of profit of associate. How much it is? 67, right? So we need to deduct. Done. So what's the next adjustment we need to do? So apart from that, there were some other operating expense. So we need to know in detail what are these operating expenses. So first, let's start with the pension scheme. So let's look at the pension scheme. So IAS 19 knowledge we have to consider, right? So the service cost component is 24 million has been included within the operating expense. So can we include service cost in the PBT? Is it a cash flow item? No, it's a non-cash expense, right? So we have to add back the service cost. So I will add back the service cost. So while preparing the cash flow, we need to add back the service cost. I will add back how much? This 19. Yeah, we are deducting it because the dividend received from associate should be shown under the investing activity. Okay. That's the reason we are deducting it from the operating cash flow. The associate profit is deducted because it's not an operating item. It's an investment item. And in investing activity will show exactly the dividend which is received. So we need to check whether any dividend received, then that amount should be shown under your investing activity. Fine. So I have service cost is 24, no? Okay. So we have to add back 24, not 19, it is 24. Now, when you look at the notes, they said that the remeasurement component of 3 million gain. Where will you record the remeasurement component, guys? According to IAS 19, where will you record the remeasurement component? OCI. It will be recorded in OCI. So do we need to include that as a part of your operating cash flow? Do we need to make any adjustments here? No. We don't need to make any adjustments because it's a part of OCI. So there's no such adjustments with respect to that remeasurement gain. Now, the benefits paid out of the scheme is 31 million. Any adjustments for benefits paid? Any adjustments for benefits paid? No, because benefits paid will decrease your asset and liability by the same amount, right? Benefits paid will decrease your pension asset and liability by the same amount. So no adjustments for benefits paid. Now, contribution to the scheme, 15 million. How will you account it? How will you account this? Contribution to the scheme. Deduct. Yes, we need to deduct it. How much it is? 15 million. So is that clear, everyone? Is that clear, those adjustments? So make sure that you write the explanations as well. Fine. Now, when it comes to the next note, the goodwill, the notes with respect to goodwill. Goodwill was reviewed for impairment at the reporting date. The impairment has rise to 10 million in the current year. So how will you account for it? Impairment. How will you account for it in the cash flow statement? Impairment should be added back. Yes, very good. So the impairment of goodwill should be added back. Add impairment to goodwill. How much it is? $10. Now, next one. Read the next note. The note with respect to PPE. The PPE include a cash addition of 134 million. So where will you show that? The 134 addition means we have purchased the PPE. So where will you show that addition? Where will you show that addition, guys? That addition will be shown in your investing activity. That will be shown in your investing activity. So it won't come as a part of your operation. The depreciation has been charged of 99 million. So how will you account for the depreciation? The depreciation has been charged to the P&L. So we need to add back depreciation, which is 99. Okay. So what else is there? Impairment loss of 43. Impairment loss of 43. So how will you account it? Impairment loss. Do we need to add it back? Do we need to add it back completely? Just read the whole scenario. The impairment of 43 million has recognized. Prior to the impairment, the group had a balance of revaluation surplus, of which 20 million relates to PP impaired in the current year. So how much amount would have reflected in the P&L in the name of impairment? Even though the impairment loss is 43, we know that with respect to the same PP, there was a revaluation surplus balance of 20. So only that net off amount will get charged to P&L, right? So when we are adding back the impairment of PP, we only need to add back 43 minus 20. Only 23 needs to get added back. Perfect. Fine. Now read the inventory portion. The last and final adjustment with respect to inventory. The goods were purchased for dinar 80 million cash when the exchange rate was $1:5. Okay. So first of all, we have to convert it to our home currency. We have to convert it to our home currency, right? So our home currency is dollars. So convert it. Convert it, guys. How will you do the conversion? How will you do the conversion? Yeah, it is 16, right? 80 divided by 5. Yes. So under the working note, I am mentioning it here. So inventory at acquisition, it was 80. So divided by 5. So 16 million is the inventory value. And inventory at reporting. How much is the inventory at reporting? What's the inventory balance left at reporting? It decreased to 16 million dinars because of the changes in the NRV, but there were no managed to sell any goods. So that decrease in inventory happened mainly because of the change in the value of inventory. And by the time it reached the reporting date, there has been a change in our exchange rate as well. There is a change in our exchange rate. How much is the change in the exchange rate? $1, it is only 6 dinars. Okay. So how will you do it? 60 divided by 6. So the closing inventory will become 10. So overall, there is a difference of how much? There is a fall in inventory of 6. But I can say that this fall is not because of the sale of goods. That fall mainly because of the impairment happened to inventory. So debit inventory and we will charge it to cost of sales, which is 6 million. So this is what the company have done, and credit it from the group inventory. So we will deduct it from the inventory balance as well. 6. Is that clear, everyone? This is what the company have done because they mentioned it here. They have accounted it correctly. The inventory is currently calculated with expense currently included in the cost of sales. Is that clear, everyone? Yes. So let's do it. So with respect to inventory, there is an impairment to inventory, right? So we'll add impairment to inventory, which is already charged to cost of sales. So we have to add it back. How much it is? 6. Done? Any doubts why we are adding back that 6? Because they said that the inventory has been correctly valued and the charge has been included in cost of sales. But that charge is a non-cash expense, right? So I have to add it back. Is that clear, everyone? Any doubts why we have added back the impairment to inventory here? Can you reply in the chat? Done. So now we need to adjust for working capital changes. So the final one, now we have to adjust for the working capital changes. So how will you make the adjustments? So there have been movement in inventory, movement in receivables, and there has been movement in payables. So we have to adjust these movements. So just look at the movements here. Check it out, whether the inventory has increased or decreased. From 165, the inventory decreased to 126. Isn't it? From 165, the inventory decreased to 126. So how will you account for it? Is it an inflow or outflow? Is it an inflow or outflow? It's an inflow. But can I say that the whole difference is because of the sale of goods or inventory? From 165, it decreased to 126. So do you think that the whole movement is because of the sale of goods of inventory? No, right? Because there is an impact of impairment as well. So even though there is a change from 165 to 126, so we can say that the overall difference is 39, right? Check it out. Is it 39? Is it 39? Yes. But I can say that the whole 39 is not because of the sale of goods, out of which we have deducted 6 million from group inventory with respect to impairment. So effectively, how much is a net cash flow movement here? How much is a net cash flow movement? Is it 39? No. So we know that from 165, the inventory decreased to 126. So we may see that it's an inflow. No, because from that I will deduct another 6. Effectively, the cash flow movement is only how much? 33. All of you got it? Why it is 33? Fine. Now, in the same way, find it for receivable. Let's find it for receivable. Receivable balance have increased from 149 increased to 156. So how will you account for it? How will you account for it? Inventory has been increased from 149 increased to 156. So almost 7 million. So is it an outflow or inflow? It's an outflow, right? Receivable increase means we have given the debt. We have given the debt to our outside ace. So we have provided the fund. So it's an outflow for the business. So how much is the outflow? 156 to 149, right? So it's a -7 outflow. Yes. And what about payable, guys? What about payables? From 197, it increased to 215. Payable got increased. So means we have taken more debt. So in the cash flow terms, the cash have come into the company. So from 197, it increased to 215. So it's an inflow. Yes, very good. So 215 to 197. It's an inflow. How much it is? 18. Good. So now sum it up. Now sum it up. So it is coming to the net cash flow from operating activities. How much? How much it is? 333. Okay, so now we need to explain it. Okay, we have to explain for the pension. We need to give the explanation for inventory. So we have already discussed those explanations. So just make sure that you are giving it just like an additional explanatory note, because marks will be rewarded for the explanation as well. Is that clear, everyone? So you can practice. Just do this as a homework. I will give you another question from cash flow. From the latest kit, Kaplan kit, take out question number 49. Question number 49. It's a question which tested in September 2018 itself. Okay, so not 39, 50. Question number 50. Tabasco. Yeah, it's up to you. That's what they have done. Either you can write it in the appendix or you can write it as a separate explanatory note in the spreadsheet. Either in the spreadsheet or in the notepad, like it's up to you. Fine. So just note down this question, guys, and you can just do this as a homework. It's question number 50 from September 2018, and the B part of the question. The B part of the question is testing on cash flow itself. So the cash flow I've tested in many settings. So we have seen now in December it got tested, as well as in September it has been tested. Okay, even in the sub questions, not just in the group cash flow, in the main part, even in the sub question they have tested this. So don't ignore cash flow. So is that clear, everyone? The group, any doubts in group? So now we can sum up the whole things that you have learned in group. So in group, basically there are 4 different areas. That is basic groups area, then the change in group structure part, then the cash flows and the foreign subsidy. Is that clear, everyone? Do you have got any doubts specifically to any questions? Okay, so make sure that you cover up almost every past papers, right? Okay, because we have done almost every knowledge area. Now we can attempt almost every questions. Okay, I will just roughly go through each and every question and will address the issues there. I think this one we have done it yesterday, right? The first one. Yes. So in the first 2 question, we'll just discuss the second part. So just read the second part of the question. So I'm just rushing a bit because we have to discuss mostly every question, right? So when it comes to the second part of this question, here it's about an investment in malting company. So what's the requirement there? What's the requirement there? Advise the directors of Sterling with illustrative calculation how 30% investment should be accounted in the individual and consolidated affairs. So before looking at the question itself, I know that if it's a 30% investment, anyway, it's going to be associate, right? If you have properly learned the knowledge part, we know that it's an associate. So tell me how the associate should be accounted in consolidated statement. How the associate should be accounted in the consolidated statement? Equity method, right? Equity method. Now, what about in the individual FS? We can either recognize at cost or using IFRS 9 or equity method. So these are the 3 options available for a company to show their investment in other entities in their separate financial statement. That will be same for subsidiary, associate, joint venture. Okay, either at cost or as per IFRS 9 or equity method. So I know the knowledge part. So if you are well aware about the knowledge, then I don't think that there is much difficulty in solving the questions. Okay. So but at the same day, if you're not sure about the knowledge part, then you will get confused. Obviously, you are going to get confused. Okay. So now look at the question. See, they have paid 2.5 million and issued loan notes with 1.1 million, which having a fair value of 1.3 to acquire 30% interest in malting company. And the remaining 70% of the equity is equally between 2 unrelated companies. All key decisions requires unanimous consent of all three investing parties. So each of the three investing party has the right of the shares of the net assets of malting and via contractual agreement. The malting reported a loss of 0.8 million for the year and dividend has neither been paid or now proposed. All three investing parties provided separate guarantees to the bank because of the malting company's poor performance in the year. So how will you account for this investment? How will you account for this investment, guys? How will you account for this investment of 30%? So when you read the requirement, we felt it like associate. Is there any change in your decision after reading the question? After reading that question, do you think that there should be any change? Is it still associate itself? Or any changes to be done? Is it a joint operation? Do you think that it's a joint operation or joint venture? Any doubts on that part? Does anyone feel like it's like a joint operation? Can you reply in the chat, guys? So there is a unanimous consent between the parties. So does it like a joint arrangement? Do you think that it's like a joint arrangement? Yes. So here there are three parties involved in that contract. So we should account for that particular company in the separate statement. As per IAS 27, we know that that should be accounted as per separate statement. IAS 27, separate financial statements, accounting treatment will be done. So in the separate statement, how will you account for it? What is the total investment here? What's the total investment? 2.5 plus 1.3, right? So in total, how much will be the value? What will be the cost of acquisition? 3.8, right? So that will be accounted as your cost of acquisition. Is that clear? So that's how we'll account it in the individual affairs. Now, when it comes to IFRS 11, we know that it's a joint arrangement. And if it's a joint arrangement or a IFRS 11 scenario, how will you account for it? So they said that each party has its rights to share of its net assets. Okay. And all decisions are made at the unanimous consent of all investing party, all three investing parties. So is it like a joint venture? Is it like a joint venture? Yes, it should be treated like a joint venture because they have a joint control in that entity. Okay. So if it's a joint venture in the consolidated statement, how will you account for it? We'll account it as same as an associate. So we'll follow equity method. We'll follow the equity method. Is it clear? Can you reply in the chat? So this investment should be accounted as a joint arrangement as per IFRS 11 in the consolidated statement. And we have to follow equity method as same as associate. Fine? Done. And we'll move on to the next question. In the next question, they have actually disposed the shares. So it will be like a change in group structure scenario. Okay. So just read the requirement. We just need to know how the disposal should be accounted. Yes. So it should be like a change in group structure situation. So just read the exhibit number 1. Just quickly read the exhibit number 1. Okay, so have you read the first part? So here they have acquired 80% and they have issued around 1 million shares. The straight line company has 1 million shares, out of which Luna is acquiring 80%. So it's our subsidiary. The goodwill on acquisition is 320,000 and has been subsequently impaired by 15%. So Luna values NCA at fair value. The fair value of net assets at acquisition exceeds their carrying amount at 200,000. This all related to a non-depreciable land which is still owned by straight line company. So why they have mentioned it as a non-depreciable land? Is there anything to be taken care of from that part? Yes, because when we are considering the net asset movement, okay, towards the disposal, there will be a change in the net asset movement. So if it's a non-depreciable land, we don't need to make any adjustment with respect to the depreciations. In the meantime, we don't need to provide any depreciation. So that's the reason they have said that whatever the excess movement is, that is because of the non-depreciable land. So we don't need to worry about that depreciation part. So on 1st January 2006, they sold 100,000 equity shares of straight line company for dollar share, $7, and the reserves within equity in the individual FS is retained earnings. The balance of the reserves is 4,658,000 and it generated a profit of 165,056, which accrued evenly throughout the year. So how will you account for it? So it's a situation of control to control or control to no control. Because we have acquired 80% of 1 million. So we have got around 800,000 shares, out of which we are selling 100,000 shares. So it is literally like a change in control from control. Control to control is a scenario. So how will you account for that change? How will you account for that change, guys? Any? So the cash proceeds, we are selling it. Okay, so the cash proceeds will be debited in cash. So debit cash, how much will be the cash? 100,000 into $7. Okay, so debit cash 100,000 into $7 and credit will go to NCA. The NCA will increase by 10%. How will you calculate the increase in NCA? The 10% of the total assets. So it will be goodwill plus net assets of our subsidiary at the time of disposal. Okay, so how will you calculate the goodwill at disposal? They have already given the goodwill at acquisition for you, right? How much it is? How much it is, guys? 320,000. So the goodwill at disposal should be 320 minus the impairment of 15%. So how much will be the goodwill at the reporting date? How much will be the goodwill at the reporting date? Goodwill at reporting date will be how much? $320,000 will impaired by 15%. So it will be 85%. Okay, that's your goodwill at disposal. So we need to find the net assets as disposal as well. We need to find the net assets at disposal. How much is the net assets? How much is the net asset, guys? They have said that the balance on the reserves is 4,650,000 directly in the question. But it is on 1st April 20x5. I need to know the net asset value on 1st January 20x6. How will you find it? How will you find it? So they said that on 1st April 20x5, the value of net asset is 4,658,000. So we are disposing it on 1st January. So how many months profit needs to be added to this figure? So from 1st April to 1st January 20x6. So we need to know the profit of April, May, June, July, August, September, October, November, and December. So we need to know the 9 months profit. So how will you find it? How will you know the 9 months profit? They have said that for the next accounting year, the company have made a profit of 165,056, right? So 165056 is the profit they have made in the next commencing year. So how will you get the net asset value? This 4,658,000 plus 165,056 into 9 by 12. Have you understood the logic behind it? How will you find the net asset at the disposal? So I've included the profit of 9 months as well. So get the net assets at the disposal date. Is that clear, everyone? How to get the total value? Yes. So this is the total assets of our subsidiary. This is the total assets of our subsidiary at the disposal, which is 100%. So out of which, how much is the percentage that we are disposing? We are disposing 10% of subsidiary. So how much is the carrying value of it? The carrying value of 10% of subsidiary will be the total into 10%. So this is what we are disposing. And how much is the sale proceeds? We are disposing it for 100,000 shares. We are getting $7 per share. Isn't it? We are getting $7 per share for 100,000 equity shares that you're disposing. You are getting $7 per share. So it is a control to control scenario. So debit sale proceeds. What about the credit? The NCA will increase. So the NCA will increase by this figure, 10%, and the difference amount will go to other components of equity. Is that clear? Can you reply in the chat? Okay, so this is how we'll account for the change in group structure. So make sure that you just practice other questions as well. Is it clear, everyone? So that's it for the day. So next day we'll be focusing on the main standards, and hopefully we'll be conducting 1 or 2. We'll be extending our marathon fix. Okay, I'm planning to extend it to 27 as well. Okay, so we can discuss more standards and the questions. So the group is done, right? Yeah, the recordings will be available in the YouTube channel. Okay. Okay, guys. So make sure that now practice. Take this time from now onwards for the next class. Try to reverse all the other questions in the group. Okay. Try to complete all questions from the past papers. Okay. Don't need to do any other question. At least from first question till 2018. Okay. So it will be coming around. If you're looking at the kit. So we have got around 10 questions. So that's more than enough. Out of which I think we have covered something of 4 or 5 questions are done now. So cover these other questions as well. Okay. The first 10 questions are from our past papers. That's more than enough. If you practice that, you will get a glimpse that how the scenario is going to come for your exams. Done? That's it, guys. Bye-bye. Take care.